Introduction. Understanding and analyzing financial statements is a critical skill for financial managers, investors, and stakeholders. Financial statements provide a window into a company's financial health, operational efficiency, and future prospects. This module explores the components of financial statements, techniques for analyzing them, and how to use them for financial planning and forecasting. Components of financial statements. Income statement. Also known as the profit and loss statement, it reports revenues, expenses, and profits over a specific period. Key items include revenue, income from sales or services, cost of goods sold, COGS, direct costs of production, gross profit, revenue minus COGS, operating expenses, selling, general, and administrative expenses, operating income, EBIT, earnings before interest and taxes, net income, profit after all expenses, taxes, and interest. Balance sheet. Shows the firm's financial position at a specific point, detailing assets, current and non-current resources owned, liabilities, current and long-term obligations, equity, owner's residual interest, assets minus liabilities, cash flow statement. Summarizes cash inflows and outflows categorized as operating activities, cash from core business operations, investing activities, cash used for purchasing or selling assets. Financial ratios and their interpretation. Financial ratios condense large amounts of data into key metrics that aid decision-making. They fall into several categories. Liquidity ratios. Measure the ability to meet short-term obligations. Current ratio, current assets divided by current liabilities. Quick ratio, current assets, inventory, divided by current liabilities. Profitability ratios. Assess the firm's ability to generate profit. Net profit margin, net income divided by revenue, return on assets, ROA, net income divided by total assets, return on equity, ROE, net income divided by shareholders' equity. Leverage ratios. Indicate the extent of debt financing. Debt-to-equity ratio, total debt divided by equity interest coverage ratio, EBIT divided by interest expense efficiency ratios. Evaluate how effectively assets are used. Inventory, turnover, cost of goods sold divided by average inventory. Receivables, turnover, revenue divided by accounts receivable. Trend analysis and benchmarking. Trend analysis evaluates financial statement items over multiple periods to identify patterns or changes. It helps detect growth, declines, or cyclical behavior. Benchmarking involves comparing a company's ratios and performance metrics against industry averages, competitors, historical company data. This comparison helps assess relative performance and identify areas for improvement. Financial planning and forecasting. Financial planning translates strategic objectives into operational financial goals. Forecasting projects' future financial outcomes using historical data and assumptions. Pro forma financial statements. Projected income statements and balance sheets based on assumptions about sales growth, expenses, financing, sustainable growth rate, SGR. Maximum growth rate. A company can sustain without external equity financing, calculated as SGR equals ROE times open parenthesis 1 minus dividend payout ratio, close parenthesis, SGR equals ROE times open parenthesis 1 minus dividend slash payout slash ratio. Understanding SGR helps in planning for capital requirements. Limitations of financial analysis. While financial analysis provides valuable insights, it has limitations. Historical data may not reflect future conditions. Accounting policies and estimates can distort comparability. Ratios do not explain causality or qualitative factors. External economic and market factors are not captured. Summary. Module 2 provides the tools and frameworks necessary to analyze financial statements and forecast future financial performance. Mastery of these concepts enables informed decision-making regarding investments, financing, and corporate strategy.